Hello and welcome everybody to our August market commentary. We're going to give it just a second while we let some people join, but as we do that, I will share just a couple of housekeeping things. Number one, today's presentation will be recorded. It'll be put live on the YouTube channel afterwards in case there's any part that you missed or you want to catch up on anything, or if you want to share it with any of your friends or coworkers, it'll be live on the YouTube channel. Another thing is we do have a chat feature here. Just as a quick refresher, it does require a YouTube account. If you try to enter the chat midway through the presentation and you don't have or you're not signed into your YouTube account, it will bring you to a different screen. So we just highly recommend, if you might be using the chat feature, make sure that you sign in with your YouTube account here soon. That way you don't get kicked out or miss part of the presentation. Obviously, there's a lot going on in markets. We have a lot of good information to share with you. We are finally starting to see the volatility that we thought we would see much earlier in the year. And we're really going to break down why that is, what's going on, what to do in your accounts based off that. And then we'll be sticking around to answer questions. So welcome everybody to the commentary. We also have a QR code in the bottom right. That is going to be to sign up for a financial checkup. So if you're unsure about some things you're doing, your accounts, you feel like you might be positioned a little incorrectly for these drops that we've experienced so far and may continue experiencing, feel free to use that QR code to sign up to talk with one of us. As far as today goes, I'm David Sedia. I'm a chartered mutual fund counselor, over 10 years of experience. I'm joined here by Austin Costello, who is a CFP, Certified Financial Planner, with over 6 years of experience. And we're going to go ahead and dive right into things.
All right, let's do it. So, how about this last week in the markets, David? A little bit more volatility than we'd seen for a long time. I think before this last week, there hadn't been a 2% drop in the S&P 500 in over a year. There hadn't been a 3% drop since sometime in 2022, if I remember that stat right. And this year we saw, or this week we saw a big one. On Monday, the S&P 500 was down 3%. The NASDAQ, which is the more tech-centered index, was down, even bigger than that intraday. I think it was 4% or something like that. It hit, and we've just seen a lot of volatility over this last week. And so what's happening, right? What's going on there? We wanted to take a minute. We actually had this whole presentation put together at the end of the last week, and David and I talked today, and we're like, we need to add some information in here about what happened over the last couple of days. So, what happened over this week? Well, one, we got some data back on the July jobs report. Okay, so how many jobs were created? What does the unemployment rate look like? And things were a bit weaker than expected. Okay, so there's these fears beginning to ruminate that maybe the Federal Reserve has kept interest rates too high for too long. Maybe that's softened the economy more than intended. So there's some economic fear there. That unemployment report also triggered something called the Sahm rule. This is actually named after the economist that kind of invented it, Claudia Sahm. And it has to do with how much unemployment has risen from its most recent low. Okay, so it triggered the Sahm rule, which is historically has been a recession indicator. So that spiked some fear as well. There's been some ongoing fears, and this is something that we have talked about. If you've been on these market commentaries with us over the last 8 to 12 months, we've been talking about this a lot, where there has been an ongoing fear that the market has been overvalued and over concentrated, meaning there's been a small portion of companies that have been pulling the market ahead because they've been doing so well, but they're looking a bit expensive. And it's always a little concerning when so much growth is driven by such a small group of companies. So that has started this rotation, is what we call it in economic terms, where people are really interested in one thing, and then they start to be less interested in that thing and they rotate out of it into other things. So there's been this rotation out of these mega cap, these large cap growth stocks, which is something we'll talk about more today. And then additionally, what was just icing on the cake is the Bank of Japan started to raise their interest rates. Now that sounds like something that should be uncorrelated from anything that goes on in the US, but Japan has been so consistent for so long at having essentially 0% interest rates that the financial markets have gotten used to that. And without going fully into details here, when Japan raised rates, that kind of caused a ripple across the rest of the world where traders needed additional liquidity. They needed to sell out of other things. So there was really this perfect storm that happened on Monday where there were a couple data points that came back, but it also highlights this overarching trend that we've been talking about this whole year where things look a little bit shaky, right? You know, the economy is being supported by this small group of companies. When any type of data comes back that they may be slowing down, it's going to cause ripples. So we'll talk about that more in a second, but let's start with the bigger picture first. So, you know, the first data point that came back that started to scare people a little bit was that unemployment continued to rise. Okay, so if you look over here at the unemployment rate and you look at these last handful of months, we've been on a distinct upward trajectory with unemployment. When you look at new jobs added, okay, we've been on a distinct downward trajectory over the last year. So, you know, we're starting to see the economy soften a bit. And how can that not be? Okay, this isn't something that should be surprising to anyone. We've seen inflation high, we've seen interest rates up higher than they've been in a decade, right? And we have just powered through each one of those hurdles, but we're finally starting to see some impact from this, you know, if we want to bring the term back from COVID, these unprecedented times, right? So what does a spike in unemployment mean? Why are people so concerned with that? Well, it's intuitive. When there's a spike in unemployment, less people have jobs, there's less money going into the economy, that causes issues, right? But there are certain points where people get more concerned than others. This SOM rule, you know, we've talked about different recession indicators in the past. There's the inversion of the yield curve when the 10-year treasury is paying a lower rate than the 2-year treasury. That's been a historical indicator. There's the leading economic indicators. These are data points put together by a group of economists called the Conference Board. This is another indicator that people look at. And as you can see here, there's this orange line going across that indicates from the recent low in unemployment. Historically, once the unemployment level crosses this line from this recent low, if you look at these gray shaded areas, okay, where these lines have crossed, there have been recessions. Okay, each of these gray areas is a recession. We've now crossed this line here. We have not entered a recession yet. But one caveat here that I just want to mention, because we don't want to be 100% doom and gloom here, is the economist that created this. Okay, Claudia Sahm. She's a living person, and actually came out and said, you know what? I know this has kind of been an indicator of recessions in the past, but this time might actually be different. Okay, because of everything that's going on right now, and because of the fact that we're recovering from COVID and things like that, this time may be different. So take this with a grain of salt. Yes, it has indicated recessions in the past, but that does not necessarily indicate that we are guaranteed to be headed in that direction. Okay, but one more data point here, and I'm sorry for the quality of this chart here, but if we look at jobless claims, okay, in purple here, how they correlate to the S&P 500 in red, typically when jobless claims, right, are headed up, the S&P 500 does not do well. Okay. And right now we've been at this point where jobless claims have been down for so long and are just starting to creep back up this direction, right? It makes sense that the S&P 500, which has been going up for so long, would start to, turn over a bit. We've just seen such strong growth for so long. Any of you who have invested, for any length of time, know that the market doesn't go up forever, right? It's got some ups and downs and bumps in the middle. So, again, we want to look at all these things. We're not trying to be alarmist or cause you fear, lack of sleep at night. It's just, things that play into our decision making when we're building out portfolios. So, David, can you elaborate a bit more on that and go into how that impacts the market and everything else around us?
Yeah, absolutely. So one of the big parts that we've seen, right, is, with the job market falling is the confidence in the job market. This is another factor which has typically surrounded recessions, is you typically see a strong level of confidence, right, start to drop. And we've seen that really happening really since COVID, right? We've kind of avoided this. And as you'll notice, this is one of the bigger declines that we've had in past years. Now, this can potentially be avoided, right? Because we want to consider why are our jobs dropping, right? It's not just fear of a recession. It is a tighter, essentially monetary policy, right? We've been since 2022 really in this restrictive monetary policy with high interest rates. That means there's less money in circulation. Companies are making less profits. In turn, their performance will shift, but also that means less people have money that they can go out and spend. And we're going to really talk about the amount of savings and things that people have and why these other companies really are putting on hiring freezes, right, or cutting some of their labor force, is because of what they are anticipating happening in the future, unless the Federal Reserve is able to counteract that, right, which begins with them starting to finally potentially start cutting interest rates here, hopefully as early as next month. So right now, when we look at that confidence, right, we see that dropping. Every time so far, that has indicated a recession. But one thing we want to point out here is, first off, like Austin said, this could be different. But number two is there's a difference between a deep recession and a mild recession, right? We believe that we have all the tools that if it is going to be a recession, it at this point could be a much more mild one, compared to something where a lot of people think recession, they think 2008, right? Which was, as you can see from the gray bar here, a very thick bar, right? It was for a long period of time. It was a deeper recession compared to something more like what you'll see in 2019, where it's just a very tiny, thin gray line, right? Is a very mild, short-term recession. That's what we think we would have if we even have a recession, where there are a lot more economists out there coming to light saying that they think, hey, we avoid a recession, but we are very due for a time where the economy slows down, right? Not seeing these crazy returns in the S&P and the growth, but starting to have a period of time where things just grow a little bit slower. So kind of moving along here, right? The next part is savings, right? We've talked about this in past commentaries. Really, since COVID, right? The amount of money that the US had in savings, the average American, spiked, right? Because you couldn't go out, you couldn't do things, you couldn't travel. So it was obviously a lot easier to save money, unless you're one of many who spent that money on online shopping. Now, if not, the savings still went up, right? And what we've seen is that has gradually gone down. And I would say the fear of COVID has gone down, but from somebody who just had it 2.5 weeks ago, COVID's definitely still around. And there is definitely, as you can see, a lot of people traveling again, going out and doing things. So in turn, that amount of savings has gone down. And as you can see on the bar here, or the line, it's actually gone down before pre-pandemic levels. In other words, people have overspent, and that amount of savings going down means that there's going to be a point here very soon where the average American is going to be spending less money, right? They're going to have to be more restrictive in what they're spending their money on. So that means some of these big tech companies, right? Like for example, you don't need to go out and get the newest and latest iPhone, right? That's going to be an easy cost to cut. So when we see this rotation out of big tech, it's because some of these are nice to haves, right? You're not going to buy as many packages on Amazon, for example. So some of those types of things are why investors are going to less risky, more stable investments. Is they still want to be in stock, but they don't want to take that extra risk. And savings is going to be that primary reason that that's happening. So on kind of a very similar note here, we want to look at the fact that a lot of equity where money was pulled out from refinances, right? In 2020, when COVID happened, to avoid a even bigger catastrophe, the Federal Reserve cut interest rates to zero again, right? That made mortgages and car loans and business loans and things very cheap, right? A lot of you probably refinanced, hopefully, into some very nice mortgages, much better than the 7% rates or upper 6% that we have right now. So a lot of money was extracted, right, pulled out during a cash out refinance, for example. And that meant that the disposable amount of money that people had increased, right? There was more money out in the system to be able to use, to spend, to stimulate, and boost the economy, which is why markets have also done so well in 2020, 2021, not so much 2022, but 2023, and so far this year. So what we're seeing is that surplus, looking at also the yellow line here as disposable income, is again, just like in the chart before, lower than the pre-pandemic levels. So we are definitely starting to see that the ability for the average American to spend is going down. And this is a essentially leading indicator for what is to happen in the future, right? Earnings of companies. And that is what people are starting to finally put their focus towards when they look at how they're investing their money.
Yeah, and
So,
just to chime in here,
yeah.
David, if you don't mind, I think this is so interesting, and it's something that a lot of people, I think, forget about the last couple of years. There's a lot of talk about stimulus from the government and money that was injected into the economy that way, but people don't really think about all the money that came from refinancing homes in these last couple of years. Like, and especially if you think about this, like, people, maybe you yourself refinanced your home, you pulled out a bunch of cash, and you didn't pull out a bunch of cash just to save it, right? You pulled out a bunch of cash to work on your home, do remodels, to build the she shed that you've been wanting out in the backyard. You withdrew money from your home, you refinanced, you pulled out equity, and then spent it, right? So that really boosted the economy in those few years when interest rates were so low and everybody was refinancing. And the fact that that money has been spent, that's not really an accurate representation of something that's repeatable, right? Because people aren't going to refinance in these hordes like they did over those times. Now we're just back to our normal income, and we can't spend money the way we had. So I think this is just, I know I'm repeating some of what you're saying, David, but just in a different way. I think it's so this is such an underrated part of what's happened over the last few years, and to expect the economy to continue to act like it did when all this additional money was in our coffers, I think that is unrealistic. So, now transitioning, to transition into your next topic, David, we're seeing this is what's happening with families, right? They're kind of running out of money. So, like, how is that actually impacting people? Like, what are people saying?
Yeah, so essentially, most families out there, right, 41% say that their cost of living has gone up so much, and that this inflation factor is their biggest fear, right? Their most important problem. And I think, Austin, just from all of the meetings we do after, folks come in to meet with us, a lot of people, that's still one of their big concerns. But there's a little bit of irony to that, which I know you're going to share here in the next slide, which is really just looking at, what is inflation actually doing, right? Like, is this still a major concern? Is this something where, we think that, you really need your investments to be outperforming, but is this anything like, 2022? Is this still high? It was 9.1%. It's obviously come down, but where is that now, and what does that look like?
Sure. Yeah. And I think it's really a two-part story, because, if we look at this, and inflation here is the black line. And so, of course, it has come down significantly from its peak, okay, to right around 4% or 3%, actually. And the Federal Reserve, their target for inflation is 2% over the long run, and it hasn't quite settled there. But we're at this point where we're really at what could be considered a sustainable inflation rate. Okay. And I think there's a couple things that are driving this 41% of families saying that inflation is their number one fear or number one priority. One of it is things got a lot more expensive, in 2021 and 2022, but we didn't realize it because of the extra cash that we all had on hand, that we were talking about before. And now, that kind of extra cash is being depleted. Student loan payments have started back up, so people are having to make those loan payments again. And we're just finally feeling the impact of where inflation has, what has already happened with inflation. Now, the silver lining of that, okay, is that the federal funds rate, so this is the interest rate that the Federal Reserve sets, okay, that kind of determines all other interest rates. Their goal typically is to keep the federal funds rate right around the inflation rate. That's typically a sustainable place for it to be. Okay, right around the inflation rate. And now, for the last handful of months, the federal funds rate has been well above the inflation rate. And so what that means is likely, and you've been hearing more and more talks about this, likely the Federal Reserve will be able to start lowering rates. Okay. The Federal Reserve affected, the federal funds rate. So that's the one I was just talking about, that the Federal Reserve sets, has been up here between 5.25% and 5.5%, and it's been here for a long time, right? Since mid 2023, we've been here for about a year at this peak rate. And now what we're starting to see is, because there's this actual data pointing to inflation has somewhat stabilized, the economy is softening a bit, there's more optimism saying that these rates are about to get cut. And that's why you're starting to see bond yields, okay, the 10-year treasury, the 2-year treasury, you're starting to see these turn over and head downwards. And this is happening in anticipation of the Federal Reserve lowering rates, okay? A lot of times, I think we look at these and we think they're exactly linked together. And so people were wondering, back in early 2023, like, why are mortgage rates skyrocketing right now? The Federal Reserve hasn't even raised rates that much. And it's because there was the anticipation of the Federal Reserve raising rates. And so everything else acted in anticipation of that before that was to actually happen. The same thing's happening now, where you're starting to see mortgage rates fall. You're starting to see long-term bonds pay less. And it's in anticipation of the federal funds rate starting to decline. So only time will tell. Back at the end of 2023, this happened. People thought the Federal Reserve was going to start lowering rates, but ultimately they didn't. And so everything picked back up again. and so everybody's a bit more cautious this time. But only time will tell if the Federal Reserve begins to lower rates. Though they are speaking much more candidly about that starting before the end of this year. So lastly, because I mentioned mortgages, there's kind of a lot going on there right now. We could have a whole presentation on that. But what I wanted to share here is that another data point is that new home inventory. Okay, so this is brand new homes. This isn't existing homes in existing neighborhoods. This is brand new home inventory. Is finally up. This chart is a little bit alarmist, right? It says home builder inventory spikes to highest level since 2009. Obviously, we get our charts from different sources, so we didn't put that there. But in reality, what I wanted to point out here is home builder inventory has really gotten about back to average. Okay, we have been below average inventory, which has caused home prices to spike because there's just not enough of them out there. We're finally up to what we could consider maybe an average level of inventory. And what's going to be interesting to see is what happens here with home inventory if interest rates do drop and mortgage rates continue to come down, right? Mortgage rates continue to come down, more people are going to be willing to spend on houses, and that could eat this inventory right up. So we'll be keeping our eye on this for home prices because I know that's something that impacts many people, including those of you on this call. So, we wanted to go through a couple of these things, right? How is the consumer being impacted? What are Americans feeling right now? What's going on with inflation? But then what we also wanted to do is tie in some of these things that we had been talking about in previous commentaries because we think it's so important. And one of the reasons that we saw what we did this week with the market and kind of talk about, what's going on within the stock market right now with these tech companies that have been doing so well and how that's revealing itself in the rest of the market. So, David, I'll turn it back over to you. Let's talk a bit about tech right now.
Yeah, let's talk about the stock market, guys. So tech has really been that silver lining the past couple of years that's been holding up markets. And we're starting to, as Austin mentioned earlier, right, see a rotation out of big tech. Right now, they're calling it the quote unquote great rotation because there's a pretty big shift going on. But tech has really been that piece holding up the market, right? It's looking very pricey, even with these recent downticks that we've had over the past week and a half. Tech still, when you look at Apple and Amazon and Nvidia, right? Those companies are still looking very pricey. And the concern is that those companies may not be holding up markets. And a lot of investors are looking for things that might be undervalued right now or fairly valued, but maybe paying a nice dividend. So they're looking at other things at this point. So tech, as you can see, is really at the highest level it's been since the early 2000s, right? And I don't need to remind anybody what happened in the stock market back then. Granted, we're not calling for such a drastic shift. As you can see, looking at what we call is the forward PE ratio, the price to earnings, right? The price of the share in relation to the earnings of the company. So we were at very, very high levels in 2000, right? Almost 60 times earnings. Right now, we're at about 30, right? So there's not much more room for things to go higher if they even were before they would need to come down to a more normal level. So this is going to be one of your issues with, the C fund, for those of you still with funds at TSP, is the heavy concentration towards this tech, right? You want to be almost more equal weight or equally dispersed amongst the market, not having such a heavy concentration in tech at this point with a lot of the risk factors that we talked about.
And one thing that I'll chip in here is I think is an important distinction because, and actually is kind of positive in the case of us not going into a deep recession or something like that, is a lot of our fears about tech. It's not that we think these companies are going to start doing poorly. right? It's just that when you look at the price that we're paying, and this chart here is not showing performance, it's showing the price for each dollar of earnings. So how expensive is it for every dollar that the company's making? And so it's just that it's gotten so expensive that if the earnings started to kind of decrease a little bit, like the earnings could still be very positive, but if they're not as positive as people are kind of hoping they're going to be, we could still see a decline in price. Um, and that's actually that's kind of a good transition into David's next slide here, um, on what's been happening recently.
Yep. So on the screen, what we're looking at is this is over the past year and a half, right? This is the start of 2023 until today, or really till the end of July. So just about a week ago. And one of the big things you'll notice is just how much higher this performance has been, even with the recent drop, how much higher this performance has been than the overall market, right? Remember, the overall market made less than 20%, right? And here we're looking at 61, 62, 66, 80, 91, 296, and 587% returns in a year and 7 months, right? That is astronomical. Now, in turn, we have seen a lot of this come down, right? Specifically, when you look at a company like NVIDIA, right? A lot of investors are saying, hey, this is too good to be true. There's no way this stands at these high valuations unless NVIDIA can come out with earnings that support that growth, right? So, like Austin said, the expectations are so high for these companies, even if they just have a quarter, like still amazing quarter, but a little bit worse than what the market has priced in, their stock values go down, right? We also want to consider, this is kind of going back in time a little bit, but if you remember Intel from back in the 1900s, right? Intel was kind of like what Apple was, or almost more like Nvidia now, but it was this huge company. People thought, hey, this can't, go south, right? This investment's making so much money. And, Intel now trades at less than or around a 20 price to earning ratio, right? So their value has come down significantly in terms of the expectations of their growth, even though that company has consistently produced positive returns, right? So what we're seeing now is from a lot of these tech companies a shift, specifically more so from the Meta and the Nvidia out to other areas that are undervalued. I'd also like to point out, which you don't see there, is we also want to think about how those companies did back in 2022 when markets fell, right? The riskier companies that do better when markets go up are also the ones that get hit the hardest when things go down, right? So on the next slide here, just talking about, the recent drop, right? Looking at since July 10th. Now this is as of July 30th. So this does not include the past week, which I'll just refresh everybody was also not very kind, right? It was even worse than this. But if we look at, we'll start with NVIDIA. NVIDIA lost 23% of its value, right? Almost a quarter of its value from July 10th to July 30th. That is $800 billion of value lost, which would be equivalent to NVIDIA losing as much as Disney, Nike, Netflix, and Pepsi. Those companies just evaporating and disappearing completely.
So the entire values of those companies. How crazy is that? The entire values.
For comparison, right, Microsoft lost 15%. That would be like those same three minus same four minus Pepsi, right? Disney, Nike, and Netflix just again evaporating, disappearing. That is a significant amount of money leaving the market. Now, what does that mean, right? Somebody was on the opposite end who saw their account value go down, right? Much like most of you who own C-Fund or S&P 500 or investments related to these, you saw your account balance go down. You and many others, to equate to $2.6 trillion between these 7 companies from in 2/3 of the month of July. And again, even more these companies have fallen since then up till today. So there's a lot of volatility in big tech. Now, before I go into this, I just want to refresh. We have been saying this for most of this year. This is not a surprise. This didn't come out of nowhere. And to be quite frank, we're surprised it took this long to finally get to this point where things started to break a little bit. We had, higher inflation in January, February, March earlier this year, which is what caused rates to delay. And we were really under the impression that, starting this summer, things were going to start falling. And it's worked its way a little bit further out, which is good. And you might recall, for those of you who joined a couple months ago on the commentary in June, one of the things I remember saying towards the end was, this is going to be one of your last chances to really lower your risk if you should be less risky. And now we're at the point where things are starting to break. So we're going to have some advice on that towards the end as far as what to do. But the volatility in big tech right now, on the left-hand side, we see Microsoft. Microsoft, their earnings were not as good as expected. If you go look at their earnings, they were not bad by any means. They just were expected to have grown by more. And their stock fell 8% in one day after the earnings report. We talked about NVIDIA, right? That lost, Disney, Nike, Pepsi, and what I missed, Netflix in value. Look at NVIDIA's trajectory here, right, with its fall, right? We also see a couple very big single-day drops, and it's fallen 27% in just 5 weeks, right? So a lot of investors, right, what they do is they see something going up and they get this fear that they're missing out on this opportunity, and they hear stories about a friend who owned it before, and then they go in. When something goes up so much, it's no longer considered a good buy, right? And that's why that diversification level comes into play. And that's where you also want to make sure that you're looking at how diversified you are across all of the market. So this was, don't see a date on this exact chart. I think it was the end of the, I'm not sure if you can see that. But on this chart here, essentially what this is showing is the record low of the amount of the S&P 500 beating the S&P 500. I know that sounds a little funky, right? So that means how many companies in the 500, or technically 503 companies in the S&P 500, how many of those companies are doing better than the average of them, right? And we can see that percentage is not even just at historical lows, but that is just significantly lower than the average, right? The average is like 40 or so percent. And as you can see, we're at about 25%, right? That means only 25% of the market is carrying the weight of the other 75%. And that means that, as we're seeing right now, right, we're seeing a rotation out of those companies, and we're seeing some of these other companies are going to have more demand, and we should see more recovery essentially in the rest of the market. So this part is a little alarming for accounts. And one more thing, just kind of really going back to support, this rotation out of these large companies is, and I know it starts just a tad blurry, but what we want to look at is the top 10 largest companies in the market, right? So in the, let's call it the teal circle here, we have the returns for 10 years, 5 years, and 3 years before a company joins the top 10 largest in the country, right? And you can see those returns have been quite nice, right? 10-year average, 11.8%, 5 years before 20, 3 years before 27.2. And then we see this shift once they have finally become part of the largest 10 companies. 3 years after, 0.5%. 5 years after, negative 0.9%. 10 years after, negative 1.5%. In other words, these companies that joined the top 10 have typically had such high growth to get them there, with a lot of speculation, that they have grown so much in value so quickly, they're no longer considered to be at attractive price points, right? They also at that point are making up a larger proportion of the indices that they fall under, like the S&P 500 or NASDAQ or NASDAQ 100, et cetera. So with these high valuations here, and I feel like I'm beating a dead horse a little bit, but this is where you want to be really diversified in your investments. And I still, at this point right now today, don't feel like it's too late if you need to make an appropriate shift. But we're going to share kind of why these next couple months here may not be the best, and that's why we still, again, right now today, feel like it's an okay time to make a shift if you need to. But when we get a little further into this month or into September, it's going to be too late. And at that point, you're kind of committed to riding this wave until things really bounce back up and recover. So Austin's going to share with you a little bit about, kind of timing and, really just like, what does history tell us about where we are in markets right now, just on just an annual calendar basis.
Yeah. And one thing that I want to stress that David said there is, David said, this is the time to make sure you're taking the amount of risk that you want to take. And if you need to make an adjustment, right, this could be a time to do that. What we're not saying right here is that everybody needs to move out of the market, right? We're not saying everybody needs to get out of big tech. It's that because it's scary, right? That's absolutely not what we're saying. What we feel our job is as financial planners, financial advisors, is to alert you to to what we see going on, to fill you in on kind of the data that we see forming, and let that inform your decisions. Okay. So something that I'll talk about later on as well is like, overall, we are very, like, if you're looking at the next 10 years, 15 years, even 5 years, we're bullish on what's going on right now. We think the economy is going to keep growing. It's going to keep being strong. What we're really trying to stress right now is, of course, when the market's this strong, we have a lot of people coming to us and saying, why am I not getting the returns that the S&P 500 is getting? Or should I put money in these companies that are doing so well right now? And this is the reason that we've said, maybe let's not chase those returns. Maybe let's keep things diversified. So that's a little bit of a tangent there, but I just want to be sure that you don't take some of this that could be construed as like negative or alarming as, hey, everybody needs to make a change here, because that's really not the case. Okay, so even though we're going in right now to this time that, we're entering slower months, right? Typically, August, September it's the worst, historical 2 months of the year. Does that mean that you should take your money out for the months of August and September and then put it back in October? No. Okay, that's not what I'm advocating here. But if you're at a point where you're saying, hey, you know what, I think overall I've taken a good amount of risk, I'm ready to set that back and move that back for the foreseeable future, this could be a decent time to do that, right? If history were to repeat itself. So whenever we show these kind of historical charts on how things have done in different months, we always look at these with a bit of a grain of salt, because history is not guaranteed to repeat itself. Okay, and we can't make decisions as if that were to be true, but we can let it guide us. So ultimately, if you were to call us up right now and ask us, what should I be doing? What changes should I be making? The major advice we're going to be giving you is make sure that you still have a balance in your portfolio between growth stocks and value stocks. Over the last decade, growth has massively outperformed value. Okay, so if you're like looking at your probably the vast majority of you are in the TSP, so you're looking at the past returns on the C fund and the S fund and the I fund, and you're looking at the last 10 years and you're like, well, the C fund has blown everything away, so I should probably just have everything there in the C fund. Well, C fund by nature is going to be heavy in growth stocks because it's weighted by how large companies are in the index, and the largest companies so far right now are Google, Amazon, Microsoft, Nvidia, right? They're all the big growth tech companies. So by nature going to own more of those by owning an index like the C fund. Now, there's nothing wrong with that, but know that there's risks associated with it. And if you're not in a place where you can stomach a loss at some point in the future, you shouldn't have all your eggs in that basket. Okay, so have a blend there. Have a blend between growth and value. Be mindful of concentration risk. We just talked about how, these indexes, just by the nature of how they're built, can have high concentrations of, a small group of stocks. You can end up with, again, I'm going to use the same metaphor, a lot of your eggs in that basket. So you do what you can to spread things out. Use some small company like the S fund. Use some mid funds. Of course, there's if you're outside of the TSP, there's a lot more options in which to invest, but do the best you can with what you have. Okay. Additionally, right now, and we didn't spend really any time on this in this call, but we will in probably some future commentaries. Don't be afraid to use bonds as in your portfolio, right? The G fund has looked great over this last, not compared to the stocks, but the G fund has looked great compared to the F fund, which is the government bond fund. And that's because bonds don't do well when interest rates are rising. Okay. But bonds do very well when interest rates are stable or they are falling in particular. Okay. So if you have put all of your conservative money in the G fund to get stability, know that if interest rates start falling, the G fund isn't going to lose money, but it's going to start paying you lower interest rates. Okay. That'll adjust down. The F fund will actually appreciate in value if interest rates start coming down. So if all of your conservative money has been in the G fund, now could be a good time. I can't say with certainty without talking to you and knowing your position, right? But now could be a time to consider adding some F fund into your portfolio or some bonds in general. We don't want to be afraid of bonds, even though their performance over the last few years has looked bad while interest rates were rising. This is the time in the economic cycle where bonds really typically excel. So David mentioned this before. We cover a lot of ground today. We've covered some things that some people may find concerning. You might want to talk about your portfolio allocation, things like that. If you have money that's eligible to be, invested outside of the TSP, sometimes that's something people want to talk about to see if you have more options to diversify further. If you have questions on those things, we offer this free. It's completely complimentary for anybody who's been to one of our webinars, watched a commentary. It's just a checkup. So it's an hour-long call with me or David or one of our other advisors or coaches. And you can ask really whatever question you want to ask, right? We can talk about tax issues like the Roth or the traditional TSP, which one makes the most sense, the allocation in your TSP, your options for what to do with that when you retire, Social Security, Medicare, all these things we can address in the financial checkup. So feel free to scan this QR code here if that's interesting to you, or go to retfed.com/register and you can sign up for that free call. So I do see a couple questions in the chat. Mike, I saw this question come in right after we moved off the slide, so I left it until the end, but I do know which slide you were referring to here, so I'll address that one real quick. And if anybody else has questions, feel free to put them in the chat. So, Mike, I saw you put that question in. It was one of our first slides where we were talking about ticks up in unemployment and how that has correlated with recessions. And you asked, does the recession typically lead the peak of unemployment? And yeah, that's likely true. Well, I don't know if that's actually true, Mike. I think unemployment, if we were to kind of draw a line up here, honestly, these are happening at relatively similar times. And if we go back here to recessions and unemployment, Yeah, it kind of depends on the year, right? A lot of these, the recession did actually precede the spike in unemployment. So yeah, they coincide with each other, and that's actually one of the reasons that Claudia Sahm, the economists that put this rule together, said that this time could be different. This rule is typically used as a confirmation that we are in a recession, not necessarily a something that indicates one is about to happen. So this could be that's one of the reasons that this could be a little different, and the reason that all these data points, we have to look at them through not just historical lens, but also, you know, how it could look this year. So I just wanted to answer that question because I saw that come in earlier. Um, but does anybody else have questions? We've got some more time on the call. Um, for those of you who joined in later, just know that of course this whole thing gets posted on our YouTube channel as a recording after this, so you can go back and watch the beginning if you need to. So feel free to do that. Feel free to share, and please, if you haven't yet, subscribe to the channel so that you get notified for these as they come.
A couple of things I'll just kind of add while we're waiting, just to see if anybody else has questions here. And a lot of people say, all this information helps, but like, what is like your like quick, synopsis or summary of like what's going on and things is, in the very short term, right? Looking at, August, September, we're definitely a little bit more pessimistic in markets, right? We think things are really trying to find their bearing right now. There's a lot of uncertainty about what the Federal Reserve is going to do with rates. Are they going to cut them? How much? What are they going to say about that? If they do cut them, what happens with inflation? Does it start to climb again? So there's a lot of unknowns here right now. So the best course, right, is to not make any major shifts in your accounts, right? Minor changes that might kind of put you a little bit better positioned if you're not already. But overwhelmingly, once the election is done, markets historically have done quite well afterwards, right? We are also, still in the early stage of a bull market. So we're not expecting there to be this huge market downturn, right? And I've definitely had people say, like, I want to retire into this year, next year. I'm concerned about what's going on right now. Like, are we going to have another big crash like 2008? And I want to just refresh everybody, 2008 was a breakdown in the financial system, right? Something was broken. It wasn't, oh, prices were just a little overvalued, or inflation was a little high, or the labor market rate got weaker. That's not a breakdown in the system, right? There's some tweaking, and time is going to be really one of the big factors that's on the side of healing this. With the labor market getting stronger, it's going to require some rates to be cut. But we have to bear in mind the Federal Reserve is going to be very slow to cut rates, right? They're not going to be quick. I think a lot of the predictions out there are excessive, thinking they're going to cut rates 0.5% twice this year, because they're going to want to see, once they do cut, what happens with inflation. They want to avoid the 70s from repeating themselves of a large period of time with high inflation. So if that comes at the cost of us having a mild recession, they're willing to do that in order to make sure that the bigger part of the economy, the inflationary factor, doesn't end up breaking the economy. So in short, you want to just keep in mind, we're thinking this is a shorter term kind of volatility period. We think things will kind of resume a level of normal next year. But what that means in terms of portfolio is just, hey, expect a little bit slower growth, right? So like Austin said with bonds, right? Bonds are not a bad place to invest when we're at a point where rates are the highest they're probably going to be, right, for a large period of time. So rates are only going to go the same or lower from here, which means if stocks are not going to be performing as strongly as they have, and bonds are going to be performing better than they have, that diversification factor now makes a lot of sense. And I know I've said it before, but we haven't had these kind of conditions for 20 years, right? Over 20 years. We've had this low interest rate environment really since the tech bubble, and that has finally started to shift. So if you all can remember back in the 80s and 90s, right? A checking account used to pay a lot more interest, right? Same with bonds. We're getting back more towards those times right now. So it looks like no other questions have come in during that, but I hope that kind of quick summary kind of helps. But I think, Austin, you may agree, but that kind of summarizes kind of like our thoughts on markets. And that's why, we're not screaming to run for the hills and make these big changes or get out of the market. It's just the same kind of thing. You want to be diversified and you want to make sure you're at the right risk level.
Yep. Yeah, I think that's a good summary, David. So I think we'll wrap up there. I didn't see any other questions come in. So yeah, if you're interested in that financial checkup, book it there. We'd love to meet you and talk to you, especially if you've been lurking on these calls for a while. We'd love to see your face and talk with you. So keep an eye out for us next month, and everybody have a great day.